Picture a crisp, physical $100 bill. Imagine walking into your local bank and handing it across the counter to deposit into your savings account. For most of us, there is a comforting image of what happens next. We picture that specific bill going down into a heavily guarded steel vault, sitting in a neat stack, quietly waiting for the day we decide to withdraw it. Mapping the actual flow shows a different story. The bank takes your $100, immediately loaning it to a local business. That business pays 12% interest back to the bank. The bank gives you 4%, keeping the remaining 8% as profit. Right now, $41 trillion is moving into deals that look very different from this traditional bank model. This change is being led by some of the largest investment firms in the world, like BlackRock and Apollo. These giants are asking, what if we just cut out the bank entirely? They call this private credit. Let's track a second identical $100 bill. This one is going to take a completely different path to the same destination. In private credit, you provide the loans straight to the business, skipping the banknote entirely. Without a middleman fee, the math changes. You capture the full interest payment, often 8 to 15%, directly from the business. This creates a check in your mailbox every month based on a fixed contract. Because these payments are based on a signed loan agreement rather than the daily whims of the stock market, the cash flow stays the same even when stock prices are swinging wildly. This sounds like a massive win for the investor, so why wouldn't everyone put their savings directly into local businesses? Moving the bank out of the way also moves the bank's protection out of the way. All the work of checking the borrower's credit and all the danger of a lost investment now belong to you. To understand the catch, look at how these paths handle a crisis. On the left, the bank route has a government safety net called FDIC insurance. If the business defaults, you still get your $100 back. On the right, private credit has no such shield. If the business goes bankrupt and can't pay you back, your money is simply gone. For decades, federal regulations and high minimum entry fees, sometimes in the millions, meant only the wealthiest institutions could participate in these direct loans, but those rules are beginning to shift. Now you can buy shares in business development companies using a standard phone app. These work like a mutual fund for private loans, letting you own a tiny slice of hundreds of different business debts. There are also online platforms where you can pick specific loans to fund. However, these often require you to lock your money away for 5 or 7 years, meaning you can't get it back even if you have an emergency. The largest, most profitable funds still require accredited status. This is a government rule that says you must prove you earn over $200,000 a year or have $1 million in the bank before you're allowed to take these specific risks. Stepping into the world of private credit always involves a direct trade-off. You are choosing to accept higher risks or less access to your cash in exchange for those higher interest payments. Despite the excitement around it, private credit is a very straightforward exchange. You are taking on the bank's daily responsibilities and its potential for total loss to earn the bank's usual profits. This raises the question, will this $41 trillion movement eventually replace our traditional banks? Banks will always have a purpose. For your emergency fund or your rent money, you need the absolute safety and the ability to withdraw cash instantly that only a bank provides. Private credit has found its home as a permanent option for long-term wealth. It offers a way to grow money through business growth without the constant ups and downs of the public stock market. Next time you see a local business expanding or a new apartment complex going up, remember that the money behind it might not be coming from the bank on the corner. It might be coming directly from investors. When you see where the money is actually flowing, you see the economy the same way the experts do. Comment below with the next financial concept you'd like us to demystify.